All right, chapter 14 is a good one. It's a little challenging, but it's an interesting one, I think, because we're going to be talking about another financial statement that we've tangentially been looking at every now and then, but now we're going to spend a whole chapter talking about this statement of cash flow. Okay, this is like the next, uh, of the. Okay, let's just do a basic review. What are the three uh, kind of financial statements we've already been doing? What are the two main ones? Like the two core ones that we spent a lot of time with. What are they? Balance sheet, okay. And then what's the other one? Yeah, income statement. Okay, these two you can think of as like the two like very core ones. Okay. What's the one that we talked about last chapter? Yeah, yeah, the statement of equity. Okay, of equity. Okay. Now, I would say this is like the least in the real world, the least of the four that are like scrutinized. These two are one and two. The statement of cash flow is the third most important. That is actually like if you're analyzing a business, those three are going to be the core ones that you're going to care about. Okay. Um, there's actually, as you saw, a lot of nuance happening here. And especially with topics like stock-based compensation, stock buybacks. This is actually an important one too. If you want to get a full understanding of kind of the valuation of the business, you can't ignore this. But I would say it's like it's the one that people least look at and probably least understand. Okay. But these other three, I would say that you need to understand what they are, what they represent, and why they're important. Okay. I would say the statement of equity is more of an advanced analysis. Okay. But if you're even buying like an ice cream shop, okay, you're gonna care about the balance sheet, the income statement, and the statement of cash flow. And a lot of times the income statement and the statement of cash flow will be very almost the same for a small business. Why would that be? Or like at least the income statement is not going to need much adjusting. Why is that? What do we talk about the different bases of accounting? What is many small businesses usually do? Yeah, Mahan. Exactly. Exactly. So that remember we had accrual-based accounting and cash-based accounting, right? So if you're using a fully cash-based system, then you're not going to need the cash flow statement because everything is going to just be presented as cash on the income statement. You would expense something only when the cash goes out. Even if you're buying an asset, you're not going to have depreciation expense. You're just going to expense the purchase of the machine or whatever. And so you wouldn't really need a cash flow statement. But since GAAP and more complex businesses use accrual for all the reasons that we talked about, matching principle, conservatism, all those principles we talked about, we are going to need a way to cut through all of that and look at the cash that's going in and out. And that's what the statement of cash flow is trying to achieve. Okay, so the way that it kind of is divided up is that there's three main like types of cash flow: operating, investing, and financing. And so we're gonna see that the statement of cash flow has three different sections where you're kind of dividing up what happened with cash into these categories. Most businesses use the indirect method of compiling this financial statement. It is much more confusing than a direct method. But it is kind of the standard, okay? Uh, and we'll see why why it's confusing as we get into the chapter. But you're gonna have to understand the indirect method because that's like kind of the vast majority of public companies are going to present their statement of cash flow using the indirect method. And it's really only different for one of the sections. So we again have these three sections. Only the operating section is really different. Okay, the other investing and financing sections would be pretty much the same under the indirect and the direct method. So, but you're going to see there's some complication in this operating section because of the indirect method. We'll talk about free cash flow. This is a financial metric that is quite commonly referred to. So it's going to be worth you all knowing what it is. And then we'll briefly just show you a statement of cash flow using the direct method. And I think after you've gone through this chapter, you'll be able to appreciate how direct, as the name implies, and simple the direct method is. Okay, and why it's not done. Maybe that's like a question for Gemini. I can do a little research and we can talk about why businesses choose to use the indirect method. I actually don't know the reason for that, but there probably is a reason, and we'll maybe next class we can talk about that. Okay, any questions so far? No? Okay. Okay, so um, what are we trying to do here? Okay, this is part of a balance sheet. Okay, this is statement of financial position is another name for balance sheet. Okay, and I forgot what company this is, Target or something. And so you can see from one year to another, cash balance has changed. Okay, so what the statement of cash flow is essentially going to do is reconcile this change in cash from one period to another. And we have a bunch of cash going in and a bunch of cash going out. And we're going to bifurcate that into these sections. And at the end, you'll see the exact amount of cash that changed in the period, and it will go from this beginning balance to ending balance. Okay, so you'll see that on the statement of cash flow. Okay, so it's really just explaining this because again, cash is the most important asset that a company has. It is like the blood, the lifeblood of the whole business. And so understanding exactly what cash is coming in and going out and where it went and for what reasons, you're gonna, you want that detail. Okay. Now, what does this mean? It's basically reconciling this T account. Okay. So I kind of lined this up. This is the starting balance. So this is the beginning balance. And this is the ending balance in cash. Okay, so we're only seeing this and this, beginning balance and ending balance, but throughout the period you had a bunch of stuff happening to cash. So these green ones, as we're going to see, are all related. These are all operating. Okay, they relate to the sales uh, and kind of the operations of the business. This buying inventory, yes, it's an asset, but it's a current asset. It's used in the kind of day-to-day operations of the business. Collecting accounts receivable, that's related to sales. Paying accounts payable, it's all related to paying your bills. So these green ones are all going to appear somehow in the operating section of the statement of cash flow. These sold old equipment, bought equipment, this is going to be in the investing section because that's going to relate to uh, the purchase and sale of assets that you're like long-term assets. And then you have the sale of stock. This is a financing activity. Okay, this is a way that the company is affecting cash, but through some financing transaction, right? We have again assets equals liability plus equity. So some borrowing has happened, some dividend got paid, some sale of stock happened. Something is happening on this side of the balance sheet related to the raising or extinguishing of capital, right? So if you're borrowing money or paying it off, if you're buying back stock or issuing stock, it's all going to appear in this financing section. Okay, but you can all see that cash is affected by all these different kind of components or categories. Okay, and the statement of cash flow again will reconcile this and this, but it's going to do it by splitting up these cash flows into their respective types. Okay, does everyone understand? Everyone good with that? Yeah? Okay, so the goal of the statement of cash flow is to cut through a lot of noise. Okay, there's a lot of noise with the accruals that are happening, estimates, uh, accounts receivable, accounts payable, all these non-cash related things that can be gamed, right? We saw how some games can be played with estimation of things. So what this is doing is getting to the heart of the matter. How much cash is going in and out? Okay, and by itself, it's not telling the full picture, but it can definitely help you paint a more holistic understanding of what's happening in the business. Okay, so the statement of cash flow on its own is not as useful as the statement of cash flow as part of this package of financial statements. Okay, so but it is an important one. Okay, so um, again, we're trying to see how much actual cash is flowing in and out of the business. For example, income statement, you can show a lot of profit, but the cash flow could be low. Okay, that could be indicative sometimes of some financial shenanigans. Okay, a lot of companies they want to, again, because the income statement is such a viewed and scrutinized and like valued financial statement that tells something important about the company, how profitable it is. A company may do a lot of things to make that net income look high. Um, and it may be artificial. Okay. The statement of cash flow will give you some indication if that's happening. Okay. Um, for example, if you're selling a lot on accounts receivable, um, maybe you're extending credit to customers who are not never going to pay you. That's going to boost your net income, but it's not going to necessarily result in a cash flow later down the line. Okay. Um, there's a lot there, like right now with the AI stuff, uh, financing cash flows and operating cash flows are getting mixed up. There will be Microsoft or some large corporation will invest in OpenAI, for example, give them investment cash flow. OpenAI will then turn around and use that cash flow that came in as investment and create revenue for Microsoft by buying cloud services or something. Okay. And why is that important? Because the use of are like when revenue appears on a company's balance sheet, or sorry, when revenue appears on a company's income statement, it's going to have a big impact on its stock price, on its valuation. Okay, so a company can boost its own valuation by investing in a company and then having that company immediately turn around and buy something from that company. Okay, so it's a way to kind of take $1 of your cash on your balance sheet and turn it into $10 of valuation for your business. Okay, because every dollar of revenue gets some multiple. Okay, so this is what I'm saying. Like you got to kind of be a fan of business to learn all these tricks, and then you can see it in the financial statements. So financial accounting, knowing this language, knowing these financial statements is one part of it, but then being savvy about business. This is another thing. You guys will have to invest kind of on your own time, reading the newspaper, reading the business section, listening to podcasts, whatever it is, because then you'll learn how all those things that happen in the business world will show up on the financial statements and how you can kind of be clued into that. Okay, so um, the statement of cash flow is going to show a lot of this stuff. Okay, so um, it also gives direct insight into how much the company is investing in its growth because it's breaking out in the investing section exactly how much the company is buying new, like kind of long-term assets for its growth versus what it's selling and kind of getting rid of. So you can see how much it's investing in its growth. Okay, so it's that investing section is also very useful. Um, the financing activity is useful because you can see what's happening on the balance sheet in terms of liabilities. That debt to equity ratio. A lot of that will be kind of revealed in this financing activity. And so there's a lot of information on the capital raising decisions of the business. And then again, the statement of cash flow will also have like between these three sections, operating, investing, and financing, it will show what changed during the period. And given that change, you can basically do beginning balance plus the change, delta. That's like a symbol for change equals ending. Okay. So the statement is really going to show this, all the changes in cash flow. And you just can take the beginning balance of cash. You'll see how much change between those three sections, and that will reconcile with your ending balance. And this is what appears on your balance sheet, this cash balance. Okay. Okay. Also, the matching principle is irrelevant for this statement of cash flow. It's just straight up looking at cash coming in and out. Okay. The matching principle is for the income statement because we want to match the revenues with the expenses. Okay. But cash flow is just looking at cash flow. It's not thinking about matching anything. All right. Any questions on this? No? Okay. Okay. So again, the format of the statement of cash flow, there's three sections, operating, and this is the cash flow generated or expended because sometimes your business is operating and it's cash flow negative, as we say. Okay, so you'll see that this is just from the normal course of the business's operations. So this one is is tied to the income statement. Okay, so if there's a large a large difference between the net income and the operating activity, the cash flow from operations, as we call it, that is like a yellow flag. You got to start asking, why is that? Okay. And there are some businesses that are like kind of structurally, like a lot of the, like if you're Blackstone, okay, Blackstone is an alternative asset manager. They're a private equity firm, and a lot of their cash flow happens at liquidity events when they sell assets, but they're constantly booking revenue based on some estimate of value of their assets. So a lot of times for these types of businesses that are using estimates to, again, book revenue and do certain things, their cash flow and their income statement, net income is going to be very different. There are some businesses like retail, okay? Target, Costco, you should see a very strong correlation between cash flow from operations and net income because Costco, they're not extending you credit. There's a cash, it's like when they sell inventory, they're getting the cash from you right away. Okay, so there shouldn't be as large of a difference in those businesses because they don't have many accruals. Okay, so but if there is something going on, something abnormal where you did have alignment of cash flow from operations and net income, and then suddenly that pattern breaks, then that's like definitely something you're gonna have to look into as an analyst. Okay, and then the investing activities, again, this is from the purchase and sale of PP&E, property, plant, and equipment, and other assets and investments that are kind of longer term. Okay, so this is like long-term assets, not current assets. Um, the current assets are going to mostly be captured in the operating activities, like your accounts receivable, inventory. That's all part of your normal course of business. So that's all going to be in here. Any changes in accounts receivable, inventory. But like when you buy a factory or you buy machinery that you're using for a long period of time, all that stuff is going to go in the investing activities. Okay. And then financing activities again, um, redeeming and issuing of bonds and loans. Okay. So your business is taking out, uh, they're basically borrowing money by issuing bonds or taking loans. They're also paying off bonds, paying off loans. So that cash flow in and out is going to be captured there. Issuing stock, buying back stock, paying cash dividends. That's all going to be included in this financing activities. Okay. Does this make sense? Is it kind of like logically common sense makes sense how we're dividing this up? Any questions or okay? Okay, I think it is pretty common sense. So okay, so another way to think about this is looking at the balance sheet. So you can see here, this is our assets on this side. and this is liabilities plus equity. And so the blue here, this is all going to be in the operating. Okay, current assets, current liabilities. That's all changing in the normal course of the business, and is going to be captured in the operating section. Long-term liabilities and equity is going to be in the financing section, and then investing is going to be long-term assets. So you can, this is an easy way to kind of visualize like what section is representing what part of the business. Okay. Um, yeah, it's not as clean. Sometimes it's like there can be instances where it doesn't follow this exactly, but in general, this is kind of how it's broken down. Okay. Okay. So just what each of these sections represents. So the operating activities section, this is going to like the cash coming in is going to be from sales of merchandise and inventory or sales of services. But remember, sometimes we're selling this stuff for cash. Sometimes we're selling it on credit and we have accounts receivable. So it's only looking at the cash coming in. So it's from sales, but it could be from a prior period because maybe you sold the services in the past year, and then this year the customer is paying off the account receivable. That cash coming in is going to appear in the current year's statement of cash flow because again, we're not dealing with matching principle in this. We're just straight up looking at what period the cash came in. It could have related to a prior period sale. Okay, so this is where the income statement and the statement of cash flows diverges. Okay. So yes, though this is true that the cash is coming from sales and inventory, it's not necessarily from the sales that appeared on this period's income statement. Okay. It's also going to include prepaid, right? So if you're an airline, you're just going to see the cash coming in from that unearned revenue cash. You'll see it appear here as a cash flow from operations. So you just really have to kind of lower your IQ for this. Okay, we're kind of getting rid of a lot of the things that we've talked about, which relate to matching principle, right? The reason why we had unearned revenues is because the cash is not matched up with the revenue being earned, right? That's a matching principle thing. But now we just care that the cash came in this period, and we're going to show it as an operating cash flow. Okay. Um, You'll also get interest revenue, dividend income when the cash actually gets paid, right? So it's not going to be like an accrual at the end of the period where we had interest revenue and like interest receivable, right? That would not be part of this. That interest revenue is going to appear on the income statement, but it's not going to be part of the cash flow because the cash has not come in yet. Okay, so basically none of the adjusting entries that we do are ever going to appear here because they're all unrelated to cash, right? We would, credit interest revenue, debit, whatever, interest receivable, right? You don't see cash in that journal entry. And as we saw in this very beginning here, it has to, for anything to appear on the statement of cash flow, one of the accounts has to be cash, either a debit or a credit, because we're really just looking at this T account and breaking down what happened there. So if there's any transaction that didn't have cash as one of the accounts, it's not going to appear on the statement of cash flow. Make sense? Okay. Okay. And then of course the cash outflows, paying for inventory, for example, paying for any operating expenses like salaries, of course buying inventory, utilities expense, when you actually pay the bill, right? Because you're going to have utility expense debit, utilities payable credit, but it's not going to appear on this statement of cash flow until you actually make the payment. And cash is part of the transaction. Okay. And then investing activities, again, from the sale, the cash inflow when you sell PP&E, you're of course going to like if you sold it for some amount of cash, you'll get cash in. If you have some investments, some bond, treasury bond, and you sell it, you're going to get cash in, right? So this is all going to be cash inflow. Um, if you're a bank and you're collecting cash from a long-term note payable, or sorry, receivable, that's going to be cash coming in because you're basically going to debit cash, credit note receivable, right? So again, this cash flow, this cash inflow is going to be in this investing section because it's related to this note receivable. The cash outflows, again, will just kind of be the opposite. When you purchase property, plant, and equipment or investments, when you make a loan to someone, that's going to be investing. And of course, if you're a bank, when you're making a loan, since that's part of your business, that will appear in the operating activities. But if you're like Google, Google has like a bunch of cash on their balance sheet, and they buy bonds just to earn some interest. That's going to appear in their investing activities section. Okay, so it depends on what the investment or the loan or the investment is bought for. If it's your main business, it's going to be in the operating section. If it's like a side hustle, side ancillary thing that your business does, it's going to appear in the investing section. Okay, and then financing activities. Again, issuance of stock, the resale of treasury stock. We saw that in the last chapter, where if you bought back stock and then you resell it, you're going to get cash in. If you've borrowed money either through issuing a bond or taking out a loan or something, you're going to see that as a cash inflow. And then cash outflow, uh, got kind of cut off here. Oh no, just got to scroll down. Okay. Paying dividends and buying back treasury stock and paying off bonds and loans. That's all going to be cash outflows. And then you can also have a bunch of like ways that you're doing this stuff, investing and financing, that does not include cash. What's an example of this? Where let's say you're buying some investment, but you didn't necessarily use cash to do it. Anyone can, yeah, Margarita. Exactly, right? So we could have bought machinery, machine debit, but we just used the notes payable. Now, I would say that this is a little bit rare because what a business usually will do is issue a bond or something and they'll get cash in and then they'll use this cash to buy the investment. So in that case, you'll see this note payable in the financing activity, and you'll see the purchase of the machine with cash in the investing activity section. It's rare that, yeah, I mean, real estate transactions are largely financed at the time with a note payable. But for large corporations, like this section is like not as there's not like a ton of stuff there because usually the financing activity is separate from the investing activity. But it could be the case that there are ways or circumstances where the financing happens at the time of investing, or there's some transaction that wasn't cash based but would have been otherwise if you just kind of split the financing and the investing up separately. Okay. Okay, so the operating cash flow section is weird in the indirect method. Okay. Um, there's a bunch of adjustments that are not intuitive that you're going to have to make, and kind of, I would think, I'm going to try to explain it conceptually. I think at first you're going to forget and like it's not going to be intuitive, but I think the more you think about it and like try to remember what we talked about today, hopefully it will become intuitive. Um, but basically, with the indirect method, we're going to start as a starting point with the net income. Okay. The net income is coming from the income statement. So we're going to have our income statement. We have that net income number, but we know that a lot of this, there's going to be non-cash things that are like kind of baked into the net income. So what we're going to do is start with the net income and just do a bunch of adjustments to it to suss out how much cash was actually transacted. Okay. So And that's why it's called indirect, because you're starting with this accrual-based number, which is net income, and then you're adjusting it to get to the cash flow. And again, this is only for the operating section. Okay. For the investing and the financing, we will just directly look at how much cash was spent in investing and came in through the investing and vice versa. But this indirect method is going to just be for the operating section. So the first uh, and hopefully like obvious, this is kind of illustrating the point, is depreciation, depletion, and amortization expenses. Okay. These are all in the income statement. Do we agree with that? That depreciation expense would have appeared on the income statement? Are we good with that? That's going to have the effect of lowering. Uh, it's a subtraction, right? It's your revenues minus your expenses. So net income is lower the more depreciation you have. Do we agree? Yes. Okay. So if we wanted to undo it because it's not a cash expense, right? Because the journal entry would have been depreciation expense, debit, and then what is the credit? This is throwback to chapter 9. I know Muhammad knows, but who else knows? What is the credit here when we took depreciation expense? Okay, I know Margarita knows it too. Who I don't want to cold call. I think I've kind of blown my pattern of doing that. But does someone want to offer their, what do you think, Aiden? Why I was pointing to you? I thought he was confident in your knowledge of this. Exactly. Yeah. Yeah, you know it. Yes. Yes. Accumulated depreciation. Well, I was trying to troll you there, man, but he got backfired. Okay. All right. Okay. So there's no cash here, right? This journal entry is non-cash. This expense, of course, is in net income. It's part of that net income number, right? It was used to calculate net income. But since we're trying to get back to cash, we're going to do an adjustment to net income to account for that. Okay, so what we're going to do is we're going to add how much the depreciation expense was. We're going to add that back to net income because net income, if we're trying to get to a cash flow, we have to adjust it upwards for this non-cash expense. Does that make sense? Yeah. So just to give you a number, let's say we had $100 of revenue. We only had one expense, and assume this revenue is all cash. We're like Costco, okay? We got $100 of cash. We had one expense, which is depreciation for $50. Our net income is $50, but we want to get back to how much cash flow we brought in. What we're going to do is add this 50 back, okay? And again, assuming this is all cash, we now have how much cash came in the door. Okay, we're going to see how we adjust revenue later because we know some revenue is not cash also because we have accounts receivable, etc. But again, just to illustrate this single adjustment in isolation, you hopefully you can see now why it's a positive adjustment to cash. Does it make sense? Yeah? Okay. Okay, so the next adjustment that you make, so this is the first, this is going to kind of be the first. In real companies, depreciation is the first, and usually it's stock-based compensation is second. Because the journal entry for stock-based compensation, when you give your employees stock, is whatever salary expense, and then you're going to usually credit like paid in capital. Okay, so this is again non-cash. You're basically saying in this journal entry that your workers have traded their labor for stock. That value of labor, let's say this is 100K. Let's say you have some worker that has a salary of $100,000. You're saying that their labor is worth $100,000 for the year. Instead of giving cash, they're contributing that labor and getting capital. They're getting stock in exchange for that. But there was no cash that happened here, right? So that's another, we're going to see it. I'll show you guys a real um, section of this, but that's like another, that's probably the second adjustment you'll see is adding back stock-based compensation expense. Okay. But in the book, they don't have it. Okay. In your homeworks and stuff, they're not going to, stock-based compensation is not really covered in this class. So it's not in the book, but I'm just telling you in the real world, when we see it, that's usually the second one. Okay, and then uh, next is gain or loss on the sale of disposal of long-term assets. Now, within net income, if you remember when we were calculating if we had a gain or loss on the sale of an asset, um, the gain was going to be in the income statement as a other income, right? So this net income is including that gain on sale of your plant asset. But since we want to have all the cash flows related to investing activities and assets in that section, we're going to kind of adjust it out of net income because we want net income to just be the stuff, all the cash flow just from operating the regular operations of the business. And we consider like the gain on sale of your tractor as just a one-time thing. Okay. So we're going to take it out of net income. It's going to reappear though in the investing section, but we're going to at first take it out of net income because again, this is our starting point. So we have to kind of clean it up. Okay, so whatever the gain or loss on the sale of the long-term asset was, it's going to depend. If it was a gain, that would have increased net income. So we need to make that a negative adjustment. If it was a loss, that would have decreased net income. So we're going to have to add that back. Okay, so it will depend on the circumstance, whether it's a gain or loss, what the adjustment is exactly. And then I'd say this is the most complicated part of these adjustments. Okay, you're going to then adjust the changes in your current assets and current liabilities. Okay, now I'm going to go into more detail about this, but accounts receivable, inventory, they're going to change during the period. And the change in those accounts is going to help you reconcile to cash. And I'll show you, we're going to talk about this in detail. But this is definitely the most confusing set of adjustments. Current liabilities, accounts payable, unearned revenue. These are also, we're going to see how they changed between the period. And based on that change, it will help us figure out how much, in the case of these current assets, we'll just see how this works. But basically, when a current asset increases, as you can see here, increase in current asset, it's going to be a negative adjustment to cash. If there's an increase in a current liability, it's the opposite. It's a positive adjustment to cash. When a current asset decreases, it means there's a positive adjustment. When there's a decrease in current liability, it's a negative adjustment. Now, why this is the case, we're going to spend some time. But does anyone have any questions on this so far? It's okay if you don't understand this right now. I'm going to attempt to explain it in a second. But any other questions? No? Okay. Okay, so uh, I'm going to give some very contrived examples so we can just isolate these changes in current liability or current asset or whatever, these changes. So this is very contrived, okay? Your company has $100,000 in expenses that were either paid with cash or accounts payable, okay? And we're going to assume that there's zero revenue, okay? So this is our income statement here in both cases, okay? So this is kind of, this negative 100,000 is going to be the starting point in our adjusting, okay? And there's two scenarios here. In this first scenario, our account payable, you can see here, is unchanged. The beginning and ending are the same. In this scenario, we had the same beginning balance, but the ending balance decreased by 13,000. Okay? So the first question I'm going to ask, and you should all be comfortable with this, is what do we need to have in this accounts payable to make this happen? What is this question mark? Yeah, Scott. 75,000. Good. Okay. And this 75,000 of accounts payable is related to what? How do we pay accounts payable off? What would we have credited? Venus? Okay, but just think about it. You're on the right track. When you pay your PG&E bill, right? They send you a bill. You have an account payable. What are you going to give PG&E to pay it off? Not like, but 75,000 what? Like, what is that? What are you giving them? Cash, right? So this is going to be the same as this orange, $75,000 of cash. Okay. And this we're okay with. Okay. Um, this 100,000 had this 75,000. These two are related. This and this are related because in this case we paid 75,000 with accounts payable, and this 25,000 we paid with cash. So that's already in cash. Do we agree with that? That 25,000? Because we just paid off those expenses straight up with cash. Okay. So now we agree that this 75,000 in cash is here. Okay. Um, okay. So let's just do the other side. So now what do we need here? What do you think? Yeah. 72,000. 73,000. Is that right? Five, yeah, 73. Okay. Okay. And this is 73. Okay. This is, um, this and this are related. This and this are related, right? Okay. So in this case, we had cash going out of 100,000, right? And you would have had some starting balance, right? You can't have a credit balance for cash, but I'm just trying to illustrate the change in cash, right? So this could have been 1,000,000, and now our balance is 900K. I just want to show you guys the change, okay? Because we'll have the beginning and ending balances, but I just want to show you how the change is kind of calculated. So we're just going to have $100,000 decrease in cash. Do we agree with that in this case? And in this case, what is the decrease here? What is my total credits to cash? 73,000 plus 40,000. What is it? 113. Do we agree? Okay. So how do I reconcile net income to my cash flow? Because now I know that my cash decreased by 100,000. My net income is negative 100,000. Do I need to make any adjustments to this? No, right? This, what I'm saying when I did this is that the net income is negative 100, but my cash flow, which again, we see here, we said that this was 75,000. We know that the total decrease in cash is 100,000 also. So this requires zero adjustment. What about this? We just saw that this was 73K and our total was 113K. So we need to adjust this, right? We need to negatively adjust this by 13,000 to get to this decrease. Agree? Okay, so now it's 113,000. So now we have the respective cash flows. This was negative 100,000 and this was negative 113,000. And they correspond to this cash, right? This is really what we care about. And the way that it happened is like, look, this AP is unchanged. There's no change in this, and therefore there's no adjustment to net income that we needed because this account payable did not change. This account payable was 25,000. What do we say here? This was 73,000. And so we basically decreased the accounts payable by 13. And that's exactly the size of the adjustment. Okay, and as we saw here, if you look in this, decrease in current liability is a negative adjustment to cash, which is what we had to do. Okay. Now there's a couple ways you can kind of square this in your mind. You can think about it like this. In this case, our beginning and ending balance did not change, and we exactly paid whatever accounts payable came in during the period, we exactly paid that with cash. So there's no adjustment. In this case, we had 73,000. So not only did we pay this, we paid an extra 13,000 to kind of pay off old debts. So that cash flow is extra cash from prior kind of things that, prior debts that we had. So that's why it's a negative adjustment. We can't just look at what happened in this period. Now that's not exactly right, because this ending balance is probably going to be mostly from here, because this 73K was probably paying off most of this or all of it. And then this ending balance is actually from here, right? But again, we're just looking at the change. The change is really what is going to help us think about the cash flow. Okay? Okay, so any questions? I'm going to do some more examples here. So in case you missed it, we can hopefully catch you up.
What is the adjustment going to be for those 13,000?
Yes. So you would just, again, the structure of this statement of cash flows, the operating section, is you start off with this net income. Now you're going to adjust it. So you would say adjustment for decrease in AP is negative 13K because it went down 13,000. And so now you just do this and you have negative 113,000. And that is how much cash flow. Remember, we had 73K here. So when we add this up, it's negative 113. So that was what changed in this period. We did have a cash outflows of 113,000. So we started with this number and we adjusted it, and we now exactly know how much cash went out. Make sense? Okay. And again, in this case, we had 75,000 here. We had a decrease of 100K. We needed to do no adjustment to this. It's already negative 100K. Because again, this did not change. Okay. Yeah. And I know it's going to take you some time to really be comfortable with this. It's not obvious. Okay. But it does work. And this is why, like, the indirect method is like, I don't know why companies do it, because you have to really internalize this whole process and understand what's going on to read the financial statement. And, most people don't really look at the adjustments too closely. They just look at the cash flow, like the end product. But I think it's important to understand what's going on. There is information in the changes in these accounts. There is information there. Okay. Okay. So now let's look at some other scenarios. So this is another contrived example. Now this only worked again because it was very contrived. We had no revenue and we only had this expense. Okay. That's why it worked. As we're going to see in the real world, you're going to have like 5-7 lines of adjustments that how did inventory change, how did accounts payable change, how did accounts receivable change, and the net of all that is going to be the adjustment. Okay, so in this example, it's very simplified because I just want to show you that this works. Okay. Okay, so now let's look at the other side where we have $2 million in revenue during the year and no expenses. So now we're just going to look at the other side where the current asset changes. The net income on the income statement is 2 million. So this is our starting point in our kind of analysis of cash flow. We're going to take the net income of 2 million and we're going to now adjust it. And there's different scenarios here of what happened to accounts receivable. So in this first scenario, accounts receivable is 2.3 million. Okay. The ending balance. So the first question is, if accounts receivable increased by 2 million, right? Because it went from 300,000 to 2.3 million, how much cash was collected? What is that? What is the question mark here? What is the answer to make this T account work? Someone besides Muhammad. Yeah. Zero. Okay. There is zero accounts receivable collected. And therefore, how much cash was collected? Really? If no one paid off their account receivable. That's what that zero means, right? So how much cash did I bring in if no one paid anything off? Zero. Yeah. Okay. So we should have zero net income here. Or sorry, we have net income of 2 million, but we should have zero cash flow. Do we agree with that? Because no one paid. We have no expenses. Our net income is 2 million, but we didn't bring in any cash flow because all of our sales, all 2 million of that revenue was from accounts receivable, and we collected no money. Okay, so how do we adjust net income? What is the adjustment going to be? So we start off with net income 2 million. How do I get to my operating cash flow? How much was my operating cash flow? We just said it. Zero. So how should I adjust my net income?
The entire amount of accounts receivable. So once we count it,
If I do this, are you sure? If I do 2.3 million, then I will have a negative 300,000. It's only the change. Okay. I went from 300,000 to 2.3, which is a change of 2 million. That is my negative adjustment. Okay. So this is going to be just negative 2 million. And that will give me to my zero cash flow. Okay. Okay. So now let's do another one. Again, same beginning balance. My ending balance is now different, 800,000. How much did I collect? Yeah. 1,500,000. Does everyone agree with this math? Yeah. Okay. Um, so my AR increased, but it didn't increase as much as this first scenario. Okay. So how much do I need to adjust net income? So again, we start with 2 million net income, and we're saying that $1.5 million was collected from this total, right? So this should be 1.5 million. So how much should I adjust it by? Negative 500K, which is exactly the change. Okay. But you have to remember, for current asset, an increase is a negative adjustment. Okay. We saw here that an increase or a decrease in accounts payable is a negative adjustment. An increase in accounts payable would have been a positive adjustment. Okay. So you, I mean, if you want to go from first principles, you'll do this kind of thing where you'll kind of see how much cash flow came in. Really, I mean, if you memorize this, you'll get the answer right, but it's coming from what we're doing right now. Okay, you'd have to go through this analysis to see the cash flows to derive this kind of breakdown. But it's basically this analysis we're doing. That's how these the directionality of this it works. Okay. Okay, so let's do this one. Ending AR is 300,000, so it's unchanged. Okay, so how much cash came in? 2 million. Do I need to do any adjustment to net income? Because remember, my net income is 2 million. No adjustment, right? Now, again, this 2 million and this are not like the amounts are the same, but this 2 million is including collections from here and from here. Okay, so conceptually, to think about how the adjustment works, you can just think about it like, okay, well, I had 2 million in credit sales and I collected 2 million. So I don't need to adjust my net income for the period. But really, this 2 million is total from this. And probably this ending balance is the amount is the same, but the customers are going to be different. They're going to be probably from the sales in this most current period. Okay, so I think just conceptually understand that. Yeah, that yes, the amounts are the same, and you're just looking at the change, but the details, who owes you money at the beginning of the year versus the end, is different. Okay. Okay, and then this last one, where our accounts receivable is reduced. How much cash did we collect? 2.2 million, right? Okay, so we saw a decrease. Okay, so we to go from net income of 2.2 million, we need to do a positive adjustment to cash for the decrease in the current asset. Okay. Okay, so I'm hoping conceptually you understand that using the changes in the current assets and current liabilities, it does relate to reconciling back to cash. Okay. Now, I'm going to show you guys a real statement of cash flow, and it's like very complicated. Okay. There's like 7, 8 different adjustments, but they're essentially each doing each of these in isolation. And when you net everything together, it does get you back to cash flow. Okay. Okay. Any questions on this? Any of these scenarios you want me to talk through again? No? Okay. Okay, let's take a little break because I think the goal for today, I want to just get through the theory, and then we're just gonna do a bunch of practice problems where you guys compile these. Okay, so let's take a couple of minutes. We'll start off at 150 again, and then I think we're getting towards the end, and then we'll spend the rest of today and tomorrow or Wednesday doing practice problems. Okay, so I want to take a couple of minutes. Okay, so um, the I would say the operating section is definitely the hardest. The second hardest is this investing section because you're gonna have to infer. You're gonna have to do some T account manipulation to figure out how to do this section. Okay, so again, this section includes the purchase of PP&E assets. Um, the T accounts you're gonna have to look at are the asset account, accumulated depreciation, and you're oftentimes going to be given bits and pieces of information that you'll have to put into the T account and then figure out what the missing thing is. Okay. Um, so if you remember this slide, uh, it will help out a lot. Okay. Um, you can see here that there's a disposal of assets. Okay. So this is going to be uh, basically potentially related to cash. It depends on what the transaction was. Okay, if you just disposed of the thing and like just threw it away, obviously it's not going to appear in cash transaction. Okay, what if it was disposed of the asset for and there was a $10,000 gain, for example, right? Or if you dispose of the plant asset for $50,000. Okay, if you did that, then you have to figure out what the journal entry was for the disposal, which you have some information here. You'll have to incorporate how much you gained or lost and then figure out how much cash was transacted. Sometimes you'll be told how much cash was transacted and you figure out the gain or loss. And so it's all about like there's 4 variables and you're given 3 pieces of information. You got to solve for the last one. Okay, so that's a lot of what the homework problems will be about. But really it's understanding this framework of how the asset and the accumulated depreciation accounts, and also this depreciation expense. Okay, this is coming from the income statement. That's also going to appear here. Um, so again, you're likely going to be given a balance sheet. You're going to see this because this will be the prior year. You'll see this. You'll see maybe this from the income statement, and you'll have to then figure out what these T accounts look like. And it basically follows this format where you have PP&E assets, you have some amount that was acquisitions, some amount that was disposed. This disposal is related. Remember, you're going to get rid of the asset in the disposal at its cost basis, and you're going to get rid of the accumulated depreciation. This is from chapter 9, right? When we talked about disposing of plant assets. Okay, so you're going to have to tie in what we covered there and the journal entries and like kind of how they affected the T accounts. And now you're going to suck out the information from that was related to cash, because there are some instances where the disposal there was no cash. The times that there was maybe also a gain or loss, and you'll have to kind of tie all that together to figure out how much cash flow was transacted. Okay. Um, but yeah, I would say just pay attention to this. You have beginning balance, ending balance. Acquisitions are obviously going to be a debit to plant assets. Disposals will be a credit. For accumulated depreciation, again, the disposals are going to be a debit. You're also going to have beginning and ending balance. These two will also appear on the balance sheet. Okay. It's just that some of this information you're going to have to ascertain from either extra information that's given to you. This you have to understand it's coming from the income statement, because this amount will appear in the income statement. Okay, so fitting all this stuff together now is, this is the challenge of this particular section. Okay, so let's look at an example. So you have these T accounts. Um, there is a $10,000 gain on the sale of some asset that you disposed of. Okay, so the first question is, think about what the journal entry for the disposal of the asset was. Okay, you have enough information here to figure it out. Um, Cash is involved, and for the purpose of compiling this statement of cash flow, you basically need to recreate the journal entry for the disposal. Okay, and cash will be part of that. And that amount, whatever cash came in, it's going to be a debit to cash, because again, you're selling this asset, you're disposing of it. That is going to appear on your statement of cash flow. Okay. Um, so why don't you all take a second and try to figure this out? Try to figure out what the journal entry was for the disposal. All right, Tyler, tell me, what do you got? Okay. So debit cash 50. Okay. Let's just do the rest of it to make sure that your journal entry is going to balance. Okay. So if you're debiting cash 50, what are you crediting? Or are there other debits? Okay. Okay. What is that? Okay. Is that debit or credit? Okay. Okay. So I'm still a little off here. What else you got? Okay. And this 15,000 here? Okay. Accumulated depreciation. Okay. So let's just, this looks right. So look, this plant asset, 55,000, that's here. This credit, or sorry, this credit is here. This debit is from here. This 10,000 is from this information that was given, $10,000 gain. And so the cash is kind of like filling in to make the journal entry balance. So yeah, this looks right to me. So let's just see. Yeah, so accumulated depreciation 15, gain. Yeah, so this is 50K. So yes, yeah, thank you, Tyler. That's great. Okay, so now that we have this cash from the disposal, what is our investing section going to look like? What investments? What are the components? We have acquisitions and we have disposals. So, what are we going to put? What are the amounts? And what is the positive or negative? Yeah, Mohammed. Positive 50 or 55? Okay. So we have cash flow coming in. It was a debit to cash from disposal of assets, 50,000. And then what else? Is that a cash? It has to do anything with cash? What else? What is the investing section showing? It's showing definitely disposal and the cash coming in. What else? Acquisitions, exactly. Okay. And unless it says otherwise, you can assume this acquisition was done with cash. Sometimes it'll tell you it was with a note payable or whatever, but we're going to assume it's cash. So is this going to be a positive or negative to cash? It's a increase in plant assets. Negative, right? This is we're spending money, cash is leaving our business, and we're getting some plant asset. So we're basically going to have cash flow from investing activities, cash flow outgoing 310,000 for acquisitions, cash flow incoming 50,000. So the net is going to be 260. Okay, makes sense? Okay, but really the big challenge is step one, figuring out what the journal entry is based on the information, and then having this understanding of this framework of where all the different pieces related to assets are going. Okay, because there will be instances where it's easy to forget about this. Okay, so you have to be very clear. Each of these pieces is important. Okay, so make sure you're like when you're having to do that part of the statement of cash flow, the investing section. I would say open this up. Make sure you're clear about whatever all the pieces are. You're gonna have to use the balance sheet. The balance sheet is going to give you this information, this, and this, right? It's going to have end of the year, beginning of the year. So give you the balances. Um, you'll use the income statement to get this. And then you will then have to figure out all this middle stuff, these changes, okay? Because they're related to cash. So though neither of these accounts is cash, you can assume that cash was involved. Like for example, to buy these assets. Okay? Okay, any questions on this? We're gonna get a lot of practice. We're gonna have plenty of time. We're gonna test your understanding of this. But if there's any questions now, please ask. No? Okay. Okay, and then the financing section I think is quite easy. Okay, it's very straightforward. Um, New loans, there's going to be cash coming in. Paid off loans is cash out. Bonds issued, cash in. Bonds retired, cash out. Common stock issued, cash in. Treasury stock purchases, cash out. And then when you pay cash dividends, that's cash out. And you're just going to list them, okay? And you'll just be, you'll see what your T account balances are. You'll be given information on, the increase or decrease in your liabilities. And you just have to uh, separate the issuances and the paying off, and make sure you're separating it because you may have, like in this instance, right? Your starting balance of long-term notes payable. So notes payable, maybe your ending balance on your balance sheet and beginning. The net is going to be 80,000 difference. So maybe you started with 80K and you had 160K, right? Um, the net is 80,000, but as you can see here, it's broken out between new 90,000 being new loans and then paying off 10. Okay, so though the net change you're going to see on the balance sheet, you have to make sure that you're splitting up the cash in versus the cash out. Okay, so the balance sheet is only going to tell you the net change, and you will have to use whatever information is provided. Though in the problem, in the in your financial records, you'll basically have notes payable. You'll have whatever starting balance 80,000, and you'll have ending balance 160, and you'll have uh, 10K here and 90K here. And somehow the information, uh, you'll have the access to the information that will tell you how this is split out. But remember that it is split. Okay, you can't just look at the net change and just assume that you've taken on new loans of 80,000 because that's not right. You actually took out new loans of 90 and you paid off 10. Okay, does it make sense? Okay. And then, of course, you have some non-cash investing and financing activities. So here are some examples. Um, Acquiring $300,000 building by issuing common stock. Okay, so this is very common in real estate partnerships. A landowner, instead of selling the land, will trade the land or they'll contribute the land into the partnership in exchange for percent ownership. So in that case, uh, their contribution, the issuance of stock is not going to be for cash. It's this land is the asset that they're contributing. Okay, so that is a financing, it's an investing and financing transaction. So, because you're raising capital, but you're also investing, right? So you would have to write this as a note. Okay, it would be included in the note because it is a financing and an investing transaction, but it's just not cash. So if you were a financial statement reader and you wanted to get an entire picture of all the investing activity, you would need to be told about this, okay? Because it's not going to appear in this statement of cash flow directly because there's no cash that was transacted, okay? Um, this one, acquired land by issuing a note payable. It's similar, okay, in that you're investing, but you're financing it in a way that didn't involve cash. You financed it directly. And again, as I said, most businesses will first issue the note payable. They'll get cash, 70,000. Oops. And they'll have the note payable, and then they'll buy the land with cash. Land, 70K, cash, 70K. So if this is how they did it in two discrete transactions, both of these will appear in the statement of cash flow because they both involve cash. Okay? It's only when they happen in one joint transaction where you have to make a note of it. Okay, is that clear? Yeah? Okay. And then this is one that, could happen. This is kind of like a financing transaction that where you're trading a liability and you're doing like a shift from liability to equity. Okay, so this these bondholders or this lender was like, okay, I think your company is awesome. I don't want cash for it. I want stock. Okay. Or it could be in bankruptcy where the lender is like kind of out of luck because there's not enough cash and they just got to accept some ownership in the business, and get rid of their loan. So this is a common transaction when there's a restructuring of a business's uh, kind of financial structure. Okay, the debt holders will either take a total loss because there's no assets to pay them back, or they can take ownership in the new company and kind of try to recoup their money by continuing the operations of the business. Okay, so this is common. This happens for sure, but it's usually for and companies have like kind of gone out of business. The existing equity holders get wiped out. The debt holders now become the new equity holders. Okay. Um, okay, so let's just look at one real life one. I think it's kind of interesting to see how this kind of ties together. And then we're just going to do practice problems. Okay. So this is target statement of cash flow. Um, it's a little hard to see, but I'll try to talk through it and scroll around so you can see better. Okay. So again, this is the indirect method. So this net income they call it net earnings. Okay. This amount for the current year, it's coming, and this is their income statement. It's coming from their 2025 net income. Okay. So this number is just getting transplanted as a starting point on the statement of cash flow. Is everyone good with that? Where the starting point is? Okay. So now we're going to have a bunch of adjustments as we talked about, because this is the indirect method. First one, depreciation and amortization, 3134. Okay, so remember this number. Let's look at where is this going to appear? Where should this appear theoretically? What financial statement is this number coming from? Balance sheet? We sure? Yeah. This is the operating section of the cash statement of cash flow. But remember, we're starting with net income. There's a bunch of stuff that are non-cash in here, right? Including depreciation and amortization. What are they missing here? They're not saying it explicitly, but exactly. So we would expect that this is how much depreciation and amortization is on the income statement, because we're starting with this net income and we're adjusting it. Okay, so let's look and see. So you can see here that it's a different number. Okay, this is depreciation and amortization, but this is a key part. Exclusive of depreciation included in cost of sales. Okay, so if you were to go read the notes to the financial statement, you would see that actually they include some depreciation expense in here. Okay, so you're trusting that the company has good accounting systems and they're able to take this and then add whatever depreciation they have included in the cost of goods sold, and they're properly putting that number here. Okay, so this number is coming from the company. It's definitely related to this. This number is included, but there's also some that's mixed in here, and we don't know the exact amount. We'd have to have access to their full accounting system to see it. So we're kind of trusting that they've done that correctly, and you trust the auditors made sure that that's correct, and they're moving all the depreciation expense as an adjustment here. Okay, so now let's look at the next one. Share-based compensation expense, 281,000. Now I wrote notes here, so let's see. Number 2, share-based compensation is rolled into selling general and administrative. So look at this is 281 million. If we look at the total for selling general and administrative, oops, you can see it's whatever 21 billion. So of their total general corporate expenses, the stock-based compensation is quite small. Okay, but it's in here somewhere. We just, we're trusting the company to disaggregate that part of this total expense and make that adjustment. Okay. And again, this is a positive adjustment because this is a non-cash expense that we're adding back. Okay, so number 3, deferred income tax. This is a negative adjustment. Okay, so what did I write for this? So it's a decrease in a liability. Okay, so let's see. Oops. Deferred income tax. Okay, so this is on the balance sheet. Um, you can see here that this deferred income tax liability is decreased. Okay, so when we do the math, it's a negative number, right? Because it's a decrease. A decrease in the liability, if you go back to that slide, is a negative adjustment to cash flow. Because you can think of it as like, not only did we have, we basically paid off extra liability, right? We've reduced our amount that we borrowed by paying extra off. So that took cash to do. Now, if we look up here, we can see that it's negative 55 versus what on the balance sheet was negative 38. Okay, so there's some small discrepancy. Now, why is that? It's likely that there's some other deferred tax in current liabilities or other adjustments. Okay, so you're trusting that the company is, since they're splitting things up between segments and they're doing complicated internal accounting, that they're properly gonna find all the deferred tax, not just in that main liability, but if it's embedded in other places, and that they're doing the full amount. But it's a little opaque, this is facts. You won't, it's like pretty much impossible for most businesses to reconcile exactly the changes on their balance sheet with the statement of cash flow, because there's like there's a lot of stuff going on in the other income, other expenses. Maybe they have a subsidiary, right? And they have deferred tax expense, so there's so much going on in these large companies that the main liability account is not including everything. There's stuff embedded in smaller amounts embedded in other things. Okay, so you're kind of trusting the company to do it properly. Okay, so number four, non-cash gains or losses. Okay, so um, let's see where we're seeing that. Number four. Yeah, this one is not easily determinable. Okay, you'd have to know some of the internal transactions that they're doing, and it's quite a small amount too. Okay, like as per like their total. Um, but yeah, I mean, it is significant. You would want to know this if you're really like a hardcore, like an analyst of this company. You would want to figure out what this is, and that would require you calling the investor relations people. They could, if you ask, they might provide you extra information, and maybe it's somewhere in the notes too. You'd have to read the full financial notes to figure out what this is. Okay, so these are kind of like expenses or other income that are adjusting. Now we're going to look at the changes in the current assets and current liabilities. So this is the thing that we were doing with accounts payable and accounts receivable. Now they're going to do all these adjustments. Okay, so inventory, other current assets, accounts payable. They're going to now look at the change. Okay, so this 436. So if you look at the balance sheet again, you can look at this change in inventory between the beginning and ending balance. I just took these numbers, and you can see this one actually ties perfectly. Negative 436, you can see 436. Okay, so it's a decrease in a current asset, which is a positive adjustment to cash. Okay, you can think about it like this. If your inventory balance is going down, you took some of your inventory, you sold it, and you didn't buy that replacement inventory. So that cash that you got from the sale is just cash flow coming in with no related cash flow going out. Okay. Okay, so what else? Which one was the second one? Other assets. Okay, so if we look on the balance sheet, we look at other current assets here, 2213 minus 1952. So it increased. Is the increase in a current asset a negative or a positive adjustment? Why don't we just start with that? Yeah, what do you think, Sab? Sure? It's like when the accounts receivable, right? We had that scenario where we had $300,000 starting, and then it went up to $2.3 million because we had 2 million in sales. How much cash did we collect? You sure? If you went from 300,000 to 2.3 million and you had 2 million in sales, so it would have been basically like this. Remember this scenario, 300K, we had 2.3 million here, and we had 2 million here. So how much cash did we collect here? Zero, right? So in this case, we had an increase in a current asset, and we can't just rely on the net income, right? Because it's overstated because we actually didn't collect any cash. So this increase related to what? A positive or negative adjustment. If we started with 2 million in net income, we're seeing here that we have zero cash flow. So how much do we have to adjust it by? Up 2 million or down 2 million? Net income is 2 million. We have zero cash flow from operations. So how do we go from 2 million to zero? Yeah. So this increase in the AR is related to a negative adjustment in cash flow. Okay. So you can see here. So increase in current asset by 261 is a negative adjustment. Okay. So oops. Other assets is a negative adjustment. Now the amount is different again because there's like buried stuff. Like it's not, this one doesn't tie out exactly. So we'd have to, uh, you know, dig into the exact details of what it's accounting for the extra around $200 million. Okay. And then lastly, accounts payable 501 negative. So just based on this, did accounts payable go up or down if there's a negative adjustment? You should now hopefully start getting comfortable with that. Just looking at the adjustment, and it should tie to your understanding of what happened on the balance sheet. Yeah, I can see some hands going into their faces because it does kind of hurt your brain to determine. So you can think about it like this. If your accounts payable is going down, you're spending like extra money to pay off old debts. It's not exactly like that because again, uh, they're different accounts payable at the end of the period than the beginning. Okay, so this negative is going to correspond to a decrease in accounts payable. Okay, so if we see what happens to our accounts payable, you can see that it did decrease by around, four or 500 million. Okay, so after all is said and done, you can see that starting from a net income of 3.7 billion, we're getting cash flow from operations that's significantly more. Okay, but this is the cash flow that they're going to have to spend on investing. So this is the investing section. Expenditures on property, plant, and equipment. You can see that they're having to invest a lot because remember, this is not a fake expense. This depreciation expense, they need these assets to continue their operations. So uh, this is kind of like a timing thing, right? The depreciation expense is also, you would hope that they're reinvesting in the business by an equivalent amount just to maintain the asset base, right? If they're not doing that, then at some point their assets are going to get old. There's no new assets to take over, and their operations will suffer. So comparing these two is informative, right? You can kind of see that they are kind of replacing the estimated breakdown or loss of value of their assets. They're reinvesting in the business. So that would be encouraging for me as an investor. I'd be like, okay, well, they're definitely maintaining their assets. Okay, so again, you see that happening here in the statement of cash flows. Okay, and then financing activities, additions to long-term debt, reductions. You can see they're kind of net not really increasing their borrowing. They've kind of just refinanced to a large extent. It's like almost the same, give or take 300 million. They paid out quite a lot in dividends. They also bought back some stock, 400 million. And then this is related to stock-based compensation. This is like in the financing section because again, as I said, the stock-based compensation is a financing activity where the employee is trading their labor for stock and you're paying them for their labor with stock. You're financing the labor with issuing stock basically. Okay. And then at the end here, you can see that you have beginning of the period cash, right? You can see on the balance sheet right here, this first line, this is beginning of the period. You have this is the net. Basically, let me just get rid of some of these. You have this, this, this. It all nets to 726 million increase. Okay, if you took this plus this plus this, or I guess this, minus this, you have an increase in cash, and that exactly explains the cash going up, like increasing from the beginning of last period to the end of this period. Or sorry, the beginning of this period to the end of this period, right? And you can see again from here to here, you fully reconcile that change. Okay, makes sense? Okay. Um, I think, yeah, let's now like try to apply this. We have a few practice problems. Let's just try to work through those. So um, if you open up the spreadsheet, we'll start with 14-22, where you're basically given some financial statements, and you're going to have to uh, basically use the financial statements because you're given the income statement, you're given the ending and beginning balances on the balance sheet, and some extra information, and you're gonna have to compile the statement of cash flow. Okay, so um, we're gonna be systematic about this. Start with the operating section. Start with net income. Um, Maybe you guys start opening this up, looking at it, and I'll put some stuff on the screen to kind of help you structure how you should do this in the order. Okay, so just open it up, start reading the problem, and I'll put some stuff on the board just to help you think about this. Actually, no, I'm mistaken. This is a warm up. Okay, it's helping you to think about how to set up the things that you will need for this statement of cash flow. We actually won't be doing it in this problem, but this is going to help you. Remember, we talked about for plant assets, there's disposals and acquisitions. Um, so this will help you figure out the precursor to actually setting up the statement of cash flow. So I think just follow the directions. We'll just go in order of these requirements. Okay, so we're gonna have to tie in various concepts to figure this out. Okay, this is why this chapter is especially challenging because you're bringing in stuff from previous chapters. It's really testing your understanding of what the balance sheet is saying. So let's go through this. Okay, so the first one, it's going to relate to plant assets and accumulated depreciation. So if I look on this balance sheet, I have my starting and ending balances for both of these. Okay, so I'm gonna just fill that in first. Okay, so for plant assets, my starting balance is 219,600, and my ending balance is 265,200. Okay, so this is beginning balance, ending. Okay, and then for accumulated depreciation, beginning 36,600 and ending 44,200. This is again a credit balance, 36,600 and 44,200. Oops. Okay. The other thing I know that happened during this period for accumulated depreciation is if I look on the income statement, I have a depreciation expense of 52,000. So if I put 52,000 here, this is depreciation expense. It's clearly not right. Okay. It's off. Because if I add these two up, it's not going to be 44,200. It's something much larger. So I know something is missing from there. Okay. So let's just continue on. So I've kind of filled in what we know based on the financial statements. Um, we don't know exactly what happened with plant assets. We're going to now kind of read the rest of this and try to fill out the rest of it. Okay. So um, we know that there was a disposal of plant assets at book value. Okay, so uh, what is the book value? In the next line, it's telling us the cost and accumulated depreciation of the disposed assets was 44,400. So what is the book value? If both the cost basis and the accumulated depreciation is 44,400, how much is it? So what is the definition of book value? Exactly. Okay, so how much is that? Any ideas? It's zero, right? The cost basis is 44,400. Over the life of that asset, we fully depreciated it. We've taken a total of $44,200 of expense, and the total accumulated depreciation is exactly the same as our cost basis. So the book value is zero. Okay, so it's telling us that we sold it, we basically disposed of it for zero. So there's no cash related to this. Okay, so we do know though that we're getting rid of $44,200 of assets and also 44,400, right? Okay, so let's just make sure that this works. This plus this minus this. Yes, it works. Okay. So we now have kind of completed accumulated depreciation in plant assets. It now is reconciling our beginning and ending balance. We have this is related to disposal, and also this is related to disposal. Now, have we reconciled this plant asset? No, we haven't, because right now it's off. There's something missing on the debit side. Okay, so we can figure exactly what that is by just taking the ending balance minus the beginning balance plus this credit 90,000. Okay, so now let's just make sure it works. This plus this minus this. Okay, let's see. Yes, it works. And what does this represent? These are our acquisitions. Okay, makes sense? Now, it would be more complicated if we sold our disposal was not just done at book value. We had like a gain. You'd have to figure out what that journal entry was, and then that would be how much you would have uh, cash inflow from disposal of assets. In this case, since we disposed of it at book value, which was zero, there was no cash that was transacted from disposal. So our statement of cash flow is only really going to have this acquisitions because there's no cash flow from disposals. We only had cash flow going out from acquisitions. Okay, so in future examples, we're going to see that, yeah, we have to actually figure out how much cash we brought in from the disposal because, there was some cash that we disposed of the asset from and we had some cash coming in. Okay, it makes sense? But figuring out how to populate this stuff, this is going to be like one of the challenging parts of this chapter. Okay, but I think it's not too bad. You guys know everything. You just now have to piece it together to kind of complete this. Okay. So yeah, why don't we finish off the rest next class because I think we only have 1 minute left. Um, and yeah, but this problem is setting up kind of the hard parts, and kind of once you've done this, you should be able to, at least for the investing and the financing section, you should have a good idea of how to complete them. And we'll get more practice with the operating section also on Wednesday.